This is In the Final Analysis. I'm Jim Yockey.
Welcome to the In the Final Analysis podcast. This is your host, Jim Yockey, and I am the Media Support Manager, Kylie. Welcome to episode 7 of In the Final Analysis. Today, we wanted to talk a little bit about something that we've mentioned before in our previous podcasts about the relationship between uncertainty and one's decision-making, especially when it comes to finance, as this is a topic that's come up a lot as kind of a baseline in a lot of our conversations with clients and audiences and other people. So, Jim, if you could please speak to how you manage uncertainty when it comes to your financial decision-making.
Well, that's an interesting question. The fact really is that uncertainties exist all throughout our life. In every decision we ever make, there's always uncertainty. That's why we have a decisional process that we work through. So as you're talking to other people and they're trying to make a decision about, or yourself, for example, making a decision. Let's say you're on a highway and it's getting kind of close to dark and you want to pass the person in front of you because they're doing 25 miles an hour in a 60-mile zone. So, the first question is, can I pass them? So there's uncertainty that I would ask you to ask yourself the question, can I pass safely? And you usually shorten that and just say, can I pass this old? Well, anyway, the fact of the matter is there is a decision there, and it's related also to the potential of doing so safely. Is it best for me? So there is an internal mental construct that about almost everything in your life. So uncertainty is a ubiquitous phrase where we run into making decisions about whether or not it's going to be good for us tonight, and it's just part of being a human. Some decisions require us to make quick decisions, and we can decide those things quickly. So if you want to kind of look at how we do it, with two parts of the brain, you have an instant reflection on whether or not it's going to harm you or not harm you. And then there's a more constructed answer to the question that requires more data, more information before you make it, a little more analytical. So to represent uncertainty as something unusual to us, it's not. It happens to us all the time, depending on what the topic of it is. So that's the first thing. So you have to discover what's the baseline. Where, if I'm talking about money, or if I'm talking about picking a college, or if I'm talking about having another family member, all of those things are questions that you're going to ask by looking out into the future and making a judgment as to whether or not that's going to be best for you or not. So a lot of that query about how someone treats uncertainty comes in just understanding how they make decisions and how they look at things. Let me give you a prime example of that. When you're talking to somebody and you're talking about making a decision that is going to be good for their money or not good for their money, for example. And this also flows over to other parts, other topics that you might be involved in. But one of the things that is basic to us that you can find out about other people pretty quickly is to ask somebody the question, what do you want? Whatever the topic is, do you want to make an investment or do you not? What do you want? The way that people will answer that is one of two fundamental types of responses. One will be they will talk to you about how that could affect them going forward, how it'll help them get to their goals out in the future. Subsequently, there are people who will say, well, I just want to make sure that this decision doesn't put me in the same position at the last time I made a similar decision. It was really terrible, and I don't want to repeat that. So they're kind of looking away from making mistakes, whereas other people are looking toward reaching objectives. And that's one of the ways that you can help them talk about it, particularly in investment, because boy, you talk about having uncertainty. There is nobody on the planet that can tell you what's going to happen in the markets tomorrow with any 100% accuracy at all. So yes, there is uncertainty all over the place, and maybe we'll talk about some of that. But the construct itself about how we treat the decisions that we have observed to be uncomfortable, and because there is an uncertainty about it. It depends on probably the topic, but it also depends on how you ordinarily make decisions about those things, thinking about it as a way of moving away from bad things or toward good things. And that's the first clue. And that way it gives someone that you're talking to an ability to help you navigate how you should collect data to make that decision. Does that make sense?
It does make sense. Thank you. Yeah. And listeners, if you want to explore your own uncertainty mindset on your own before talking to a professional like us, we have an uncertainty mindset survey available on our website by Atlas Point, which you can take through our financial intelligence, your money emotions tab. And so, Jim, I have a kind of a two-part question for you about all of this. The first being, what do you see as the factors that are impacting people the most in their lives towards their financial decision making? And part two, we can get into later, is what are some of the world factors that seem to be impacting the larger decision making in the finance industry?
Ooh, two really different questions, both vitally important. The first thing is when you're talking about money, money is very close to the heart. We're very private with it sometimes, very boastful sometimes, but we are very serious when it comes to our money, particularly when you talk about investing. Even when you're thinking about just buying something, purchasing something, it's important to us too, but it depends on how much emotion is involved. When you're buying a new car or something, you have a set of items that you have to have before you make the decision that you want to pick out and purchase a car or whatever you want to buy. Investing has more uncertainty about it because it's not as touchy-feely. You can't open the door and sit down in it and see how it smells and blah, blah, blah. See how fast it goes, how quickly it gets there. There's more emotional charging of one's analysis of making an investment. Pardon me. And that's probably because we lack a lot of understanding about how markets really work and how investments work and how to choose them sequentially, proportionately. There are a lot of decisions about making decisions. Length of time is that you want to have that money in that particular spot. So there are a lot of things that go into it, and the real problem that we have mostly as human beings is making a decision that this is the decision that I want to make. Brings out all kinds of emotion. Why do I want to make this investment? What am I trying to achieve? Do I want to make more money? Do I not want to lose any money, which we talk about all the time? But anyway, the fact of the matter is all of those things are emotionally charged. And when you become more in tune, more educated about investing, and there are a million ways to enhance your education. Our website, obviously, is one of those sources, and I try to talk to people who come in. I say, look, if we work together, you're going to become a better investor because you're going to get a lot more information than perhaps you have gotten before. And we're not going to be satisfied until you have a complete understanding of what the decision is, what are the consequences of that decision, both good and bad. And that data will help you set aside some of the emotional reactions that we have to these kinds of decisions to make a more concentrated, rational decision. We could. There are a couple of different ways that we could largely talk about rational versus emotional because behavioral finance is all over the place, and we certainly have things on the website to talk about behavior finance, but also I'm sure that we're going to talk in more detail about how emotions affect these decisions because of some of the shortcuts that we use in life to make those decisions and whether or not they're good for us. So I hope that answered the first part of the question.
Yes, thank you.
Maybe it answered the second part of the question too. I'm not sure.
Well, I'm interested to know like what if there are any specific hangups that people tend to have that you've noticed about things that are making them the most uncertain about their financial decisions. Is it things mostly in their personal lives? Is it usually things out in the world like politics or whole market volatility? What tends to come up the most in your conversations?
Well, that is a very good question. Depending on what happens in the real world, you know, we get emotionally motivated by a lot of the information that we collect these days. If you look back 25 or 30 years ago, we didn't have as much access to information as we have now. In 1982, when 401ks, retirement plans were replacing defined contribution plans or defined benefit plans, 401k is a defined contribution plan that we have today in the 401k. A defined benefit plan was what we used to have when we had pensions to look forward to. But so in any event, we hadn't, I don't say we, because some people didn't suffer from the same myopia in terms of investing their money. They just put it in the bank and went on down the road. But when we started to make decisions about investments in retirement, vehicles like IRAs and 401ks, which happened in the early 80s, all of a sudden we really didn't know how to make those decisions because we listened to our neighbor or we listened to somebody at work or we weren't really adept at making concrete decisions how we should deploy our money at that point in time. In 1995 or so, along comes the internet, and all of a sudden we're awash with information. Everybody wants to tell you how to invest and how you should not invest, and all of that. So we have exchanged a lack of knowledge to too much availability of knowledge. And so if you're going to invest your money, you're going to do it based upon two fundamental things. One, what do I need in the future? What do I want my life to look at in the future? Am I investing my money so that I can have a comfortable retirement? That's an easy one for everybody. And then attached to that are current events, current differences between the economy, for example, and an investment strategy, investments versus the economy. And they are related, but they're not the same thing. And then you put an umbrella over that thing called, as we found out in the last, I don't know, maybe 10 or 12 years, who changes the rules of investing? Who changes the rules of the economy? And that's politics. And so politics has become an influencer in terms of making decisions. And boy, let me tell you, that's where emotions really run hard. I'm not particularly a political. I'm an agnostic when it comes to politics, but in our course of talking in the final analysis, it is going to be there, and we intuitively know that those people have the ability to change our direction and our assumptions about our investments. We've talked about the Federal Reserve. That's one part. We've talked about election of people who make the rules, like Congress and the president. And then there are international situations like we're experiencing with Ukraine and others. So all of those are bundling in to try to influence you to make decisions in one way or another. And what you want to do at that point, if you're too confused about what what you're going to do, then you should stop, take a breath, and reevaluate the fundamentals of why you're doing what you're doing. What am I trying to accomplish? Who do I trust to help me do that? And how long do I have any escape valves? Can I take a side street to this investment, or am I locked in forever? Those are very valuable questions. And it's acknowledging the fact that there is too much information that has come in that you don't know how to make a solid decision for yourself. I hope that answered all of those questions. I'm not
No,
sure.
thank you. Yeah, I think it's so important that you mentioned that, especially when something big happens in the world that could affect your personal finance strategies, is to stop and to take a breath and do a values check-in with yourself. We actually have a whole white paper on our website called Don't Panic for things exactly like this. We published it right after the COVID-19 pandemic started, which was a very special circumstance in the world that scared a lot of people and made them very uncertain about their lives, both in general and financially. If listeners, if you want to take a look at that, it's on our website in the special news tab of our resources. And then, yeah, being able to reach out to financial professionals to be able to talk down that uncertainty back into what your goals are and what we can do to help achieve them is so important. And it's like you said in our actually last episode, you're a 24/7 guy. Our clients know they can always call you whenever they reach a peak of uncertainty that they really want your help.
Yeah. And they've proven that they will call. And that's good, though. No problem.
Yeah. And besides these huge global events that can really rock someone's sense of certainty, what are you finding are the most frequent examples of the smaller, more personal things that make people uncertain on just the day-to-day level of their financial journey?
Well, this gets back into things like the thumbnail decision things they really, I guess what you call it would be a rule of thumb, and these are I want to use a big word called heuristics. And what that means is rule of thumb. And what's interesting is when we go out to buy something, we formulate a strategy, okay? And for example, we mentioned buying a car or something, and the decision to buy between electric and hydro. We're going to run it on water one of these
Right.
days. Anyway, so what we do is we tend to go through a sequence of questions that we have to get through in order for us to make a decision. What color? Does it have 4 doors, 2 doors? How big is the engine? How big are their tires? Whatever. Interestingly enough, that strategy becomes embedded in us unconsciously. And we'll use the same strategy at the grocery store to buy a can of peas or something. You look at the label. Is it who is it made by? Who I want to do? Well, what's the color of it? What's the size of it? But it's all the same strategy. And this happens to us all the time. We develop a strategy that it gives us the opportunity to make decisions more clearly and more quickly. Okay, so these strategies can also evolve into something that may not be as useful. For example, we could call those bias. Everybody on the planet's talking about bias these days, ever since the behavioral finance folks started getting into anything and arguing with the economists. But the reality is these shortcuts, these I don't think that we're even aware that we have developed them. And I know that we're not aware that we're using these. And some of them have developed into biases that make mistakes because we make them too quickly instead of rethinking. So let's say, for example, that you bought, and it could be a car, it could be a stock, doesn't matter. Okay. And you get into it and you drive it for a while, and you're always evaluating that you made the right decision. Okay. And at some point in time, like with money, for example, if you look at it and you see, I think I made a mistake. All right, you bought something and it went up in value, and then all of a sudden it slips through the floor and doesn't seem like it's going to stop going down. And you say, well, I don't know if I want to sell that thing or wait till it stops and maybe I buy more or something like that. Well, you're investigating a bias that we have developed of whether or not we're going to sell it or keep it or wait and buy more. It's called the sunk. What is that?
Sunk cost fallacy.
Yeah. It has been this lean. Yes. So the fact of the matter is, it's one psychologically has been studied, many times, but we forget that if I sell it, then I can take that money and do something else with it. Yes, the loss is still going to be the same. I can hold on to it and hope it doesn't go down any further. The mechanism, the results are still the same, whether we buy, sell, or whatever. The decision to do that is based on the same parameters. And it's either way, either decision that you make is going to be, representative of the outcome for you. It either went down and came back up, or you sold it and it went down, or you sold it and it went up. All of those things are in that evaluation. And we tend to get so emotional about sunk cost that it causes us to make the wrong decision. I don't know how many times, being in financial services for generally a lifetime here, but I know there are so many times that I have bought something and I could have waited. I have sold something and I shouldn't have, and those things happen. So you got to make an evaluation without bias, without the emotional part. So you have to look at the data underneath. What happens if this? What happens if that? What if I don't do this? What if I do that? And if you answer those questions, it'll help you get closer to avoiding this bias. But we develop these little shortcuts, okay? And then some of them become biases because we don't want to make mistakes, or we don't want to, or we do want, do want or do not want, becomes a category of emotionally charged information that we tend to utilize almost unconsciously, and it's repetitive. So I hope that helped.
Yeah. Would you say that getting to understand the heuristic strategies and the biases of clients and potential clients and those you talk to and advise is part of that part of the getting to know them is important to how you work with them and how you guide them on their financial journey?
Yeah, absolutely. Um, Helping people understand more about the decision, giving them more data to make a more balanced decision is important. Because we we're dealing with other people's money, and that's a very big responsibility, and it needs to be cared for. We call it in the industry the best interest of the clients. Well, I don't know how you could be in this business and not have best interest at the top of your mind. But anyway, the bottom line is the way you do that is to make sure that they understand what and why you're trying to do whatever it is that you want to reach an objective that they have thought about and that you have brought to light to discuss. And so the reality is that you just ask enough questions and keep them thinking about it and answering those questions in ways that they can understand what the construct looks like. What is this, what manufactures a good decision in this particular thing. And that's just a good common sense. Each of you have to understand what the other is really meaning. And then you can also say, well, the disadvantage of making this or not making this decision is the following, just like sunk cost. It's a good decision or it's a bad decision, but what would you do with the money if you made that decision? Whether you bought and sold or you sold and bought, you might want to take it and go buy a new car. Anyway, so that the idea is to help illuminate their total process of making the decision, and that's just good common sense. I think some people probably need more of.
No, yeah, that sounds like a really helpful way to help mitigate uncertainty of the decisions, not only that they want to make, but how we help handle them as a management firm.
Yeah, some of these things are, I think, they're on the website, kind of, that talk a little bit more about bias, and I think coming up too, we're going to have some deep dives into biases um, to help people understand how easily it slips into a bias and how to avoid mistakes with those. So that's going to be fun too.
Yeah, absolutely. And for anyone wondering, you can find our bias pulse checks by Atlas Point in our Your Money Emotions section of our financial intelligence resources on our website. There's several of those that you can take to check different types of biases that could be affecting your financial decision making. And yes, we will be digging into a few of those more specifically here on the podcast in the future, including next time, where we'll be talking a little bit more about the emotions relationship with money, especially when it comes to happiness. And so we will get into all of that next time.
Yes, and uh, in the last, yeah, here we go. So, in the final analysis, our job is to help people understand how to make good, concrete decisions in life and money.
That's right. All right. Well, thank you so much, Jim, for your time today. That's currently all the time we have. But you can find everything that we've talked about resource-wise at www.wisdomchoice.net, mostly in our financial intelligence tab, as well as our special news tab. You can also sign up for our newsletter through our website, where you can learn more on a bi-weekly basis about special topics and the monthly market insights. And please let us know if there's any specific topics or questions that you have that you would want us to talk about more. You can give us a call or send us an email. All of our information can be found on our website. Thank you all so much for listening. We'll see you next time.
Thanks for tuning in to the final analysis. We try to keep you informed. Be sure that you're on the email list and call us if you have any questions whatsoever. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professionals before making important investment decisions. Securities offered through Cambridge Investment Research, Inc., a registered broker-dealer, member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Wisdom Financial Management, LLC are not affiliated.